Hello, my name is Lee Schultz. I'm a faculty member in the Department of Economics at Iowa State University. The purpose of this short tutorial is to call your attention to an Excel-based decision aid to help cow-calf producers identify the net present value of replacements that might be available for purchase and placement into their herd. To obtain this Excel-based decision aid, you can go to the Iowa State University Ag Decision Maker website. And here is the home page for the website with the address here up in this bar. And to obtain the spreadsheet, click on the Livestock tab, and then Cost and Return, and then scroll down to the Profitability section here. And then under the title Net Present Value for Beef Replacement Females brings you to the home page for this particular decision aid. On this decision aid, we have a small fact sheet that describes how to use this decision aid, as well as provides our contact information for the authors, both Patrick Gunn from the Department of Animal Science and myself. So to download the website, to download the decision aid, please click on the Excel file here, which brings up the decision tool. I would also encourage you to come back frequently to download the most current version of this tool, as we do update this as time goes by to keep this as current as possible. So once you have the spreadsheet brought up, to note here, we have the yellow cells are user inputted cells, and so this will be specific to your individual operation and your individual decision. So the first input for the cell is for the purchase price of the replacement female. Now I'm going to use $3,000 purchase price, and I'm going to assume we're going to purchase this female in 2015 and the first year of calf sales in 2015. Now also we need to look at the number of calving opportunities, and so I'm going to use 7 here for the number of calving opportunities and 100% marketable calves. Now important here is, if you're going to use this decision tool to look at a lot of replacement females, it may be important for you to adjust the expected calving opportunities or the marketable calves for the average of the lot. And then here, the last input for the purchase and financing of these replacements is looking at the discount factor. So think about the discount factor as the opportunity cost, and so it's really the relative risk of this investment. And so here you can use a proxy for this as an operating loan, the percentage interest for that. So next, look at the production and prices. And you'll note, because we assume purchasing this animal in 2015, first year of calving in 2015, and 7 marketing opportunities, this ranges from 2015 to 2021. Next, we need to put in steer weight and heifer weights, and so these would be the weaning weight or the marketing weight of those calves. And so I range these from 2015 to 2021 for both heifers and steers, and then an expected price. Now it's very important for the expected price to use a variety of sources to give your expectations for price, because this really drives the bottom line decision for this investment, how profitable those cows will be relative to the purchase price and the annual cow cost. This model also does assume that it's 50% marketable steers and 50% marketable heifers from this replacement animal. Next, we look at the cull cow weight in year 2021 when we market that cull cow after the end of those 7 calving opportunities, and an expected cull cow price. Next, we'll have to put an annual cow cost in, and so here I assume a fixed annual cow cost of $750 over the life of this investment. Now again, this is going to range by different operations and could range throughout that 7-year period. We also do have a section for annual heifer development cost. If this heifer would be purchased as a replacement heifer, there may be some added costs onto that wouldn't be included in the annual cow cost, as I'm maybe purchasing a 2, 3, 4-year-old cow that wouldn't have those added replacement costs. So then we see that we get the income above annual cost per year, which is driven off of those marketable calf prices as well as the cull price and the annual cow costs and any additional heifer development costs. And then if we scroll down, you see our net cash flow for the period of that investment, the cull cow salvage value in year 2021, and then the annual pre-tax cash flows. And here we have that initial purchase price of $3,000, and then adding it, then we have all the subsequent year annual marketing values for those calves. And then we just can take the cumulative, which is taking that initial purchase price plus all those annual pre-tax cash flows for the life of this investment. And then looking at the discounted cash flows, so we look at the present value of the annual pre-tax cash flows discounted by that discount rate of 5% that we used, and then again the cumulative value of those pre-tax cash flows. So then it's important to look at the profitability indicators from this investment. So if we look at the nominal or undiscounted indicators, we can first look at the average annual pre-tax cash flows. So this is just the annual cash flows divided by the life of the investment. Next, we can also look at the internal rate of return, which is a measure of the return on the investment and takes into account both the timing and magnitude of those future cash flows. And so it takes into consideration the larger prices for those calves in the near term as opposed to prices decreasing further down the line in those investments. Next, we have the payback period. So this is the years until the cumulative value of the annual pre-tax cash flows exceeds zero. So when we look at when this investment would be paid back, it's year 2021. I will note here when we look at that nominal cash flow standpoint that it really is that cull cow value at the end of year 7 that brings that above the zero break-even line. And then very important is to look at the discounted indicators, because we know that a dollar is worth more today than it is into the future. So it's important to discount these cash flows as we look at this investment. So we look at the net present value here of $130 from this investment. Important is that this net present value is positive. If this net present value would be zero, that would show that there's no net present value from this investment of these replacement females. And then finally, I'd really like to point you to this max bid price for replacement females, and really to look at the risk of purchasing replacements at higher and higher prices. So remember that we assumed a $3,000 purchase price for this replacement female. Well, given the situation that we put in here for calf prices, for both steers and heifers, for cull cow price, and then the annual cow costs, the max we could have paid for this replacement female would have been about $3,100. So you can see that we're not that much further below what our actual price was than what the max bid price could have been. When developing this spreadsheet for your own situation, I would encourage you to run a lot of sensitivity analysis around a lot of these user inputted cells to really gauge the risks presented by the situation of retaining or purchasing replacement females. Thank you.